Brent, let me ask you, you seemed a little concerned about what you describe, and this goes way back in the lexicon of economics, to a wage price spiral. You point to the fact that a couple of large employers, Amazon, Walmart, and of course now the longshoremen, are going to get major wage increases over the next few days, and that this could continue, this could feed into more inflation. How worried should we be? How worried are you?
I think there's a delicate balancing act the Fed has to try to navigate, which historically they haven't done a very good job. They do tend to wait till the labor market shows signs of weakening. And unfortunately, because they do that, it tends to trend and then it's too late. I think this time is a bit different just because there is still inflation. The embers are still burning. This is a late cycle economy. We have fewer workers still, even though we have a bit more unemployed than we did. But if demand picks up, where are the people going to come to create this supply to keep inflation lower? At the end of every economic cycle, wages rise. That's what happens. And that typically is the final frontier for the Fed to begin cutting. They had to this time, even though they're still above the Fed's target, because they did see signs the labor market is weakening. And since they cut now, you've seen a jobs report that taken at face value is stronger, and now CPI that I just disagree a bit with the context there. If you look at the median CPI, which the Fed does take a look at, it rose about 0.4%. So did Supercore X services. Inflation is not burned out. And so I think the path forward for the Fed is a bit more difficult than investors are currently thinking about.
Interesting point.
Yeah, Mike, what would you add to that? And for the weeks to come, what's really going to dominate? Is it going to be the data? Is it going to be odds of what the Fed does? Or is it going to be the election?
Well, and you got earnings thrown in there, too, Kelly.
And earnings,
so I think that
right.
earnings would perhaps be a welcome distraction if, in fact, it did come into more sharp focus. Look, PPI tomorrow, I guess it's going to matter for the PCE. I mean, we're going to be reading through all these things. And I don't disagree that at some point in this process, stickier inflation becomes a problem for the Fed. I just don't know that it's right now with the Fed funds between 4 3/4 and 5 and a lot of room between now and neutral. I also don't think that the stock market would mind a less Fed easing or less Fed accommodation if it were combined with a more solid economy. I think it is the election in terms of a lot of hedging going on, a lot of people expecting some more choppiness in October, but it not really showing up at this point. And I see these surveys, the retail investor survey, lowest number of bears in the AAI survey since late last year. So people are generally upbeat about how this year ends. They just feel like there might be a little bit of static between, here and November that they might have to navigate.
Brent, you seem a little bit also concerned about valuations, particularly for large cap stocks, and think because, as you said a moment ago, we're in sort of a late cycle phase here, that maybe the turn is coming eventually to smaller caps. We've been hearing that a long time, and so far it really hasn't materialized.
You heard it a long time back in 1999, 2000, which was a very similar market where the market became very narrow because the economy became very narrow. What's holding up the economy right now is a smaller slice of it. Think about manufacturing. Think about the lower end consumer, the middle income consumer that has been harmed by interest rate hikes. And it doesn't appear to me that the Fed's going to be able to aggressively alleviate that. And I guess the question is what happens next? Look, I think one way or the other, for investors who are more interested in returns over a 3 to 5 year period, I think small and mid cap stocks, regardless of a soft landing or not, offer value because they have been priced somewhat for a recession. On days like today, when rates are up, you see the Mag 7 doing well and carrying the S&P 500, while more economically sensitive parts of the market sell off, like small caps. At some point, that is going to flip, and I think that's nearer rather than further away.
But, Brent, isn't inflation and sticky inflation a much bigger issue for them, stickier rates? The Russell earnings were flat for 3 years as rates spiked. So wouldn't this be the worst-case scenario now?
How much of that is already priced in? I mean, take a look at their performance and tell me who doesn't know that they're economically sensitive and hasn't been buying the Mag 7 at whatever levels because they're less economically sensitive or believed to be. And that's where I just think it's about looking forward and thinking about what the likely outcome is. And I don't think the Fed's going to be able to cut aggressively, which is a headwind until it isn't. And that's when I think it's too late to try to time owning those. And so we continue to think about being investors, and we continue to position towards what's cheap and where there is less optimism, which I remind you, optimism is a contrarian indicator. And you've seen a large amount of optimism in the AAI sentiment survey. You've seen it in the conference board, people thinking that stocks are going higher. That's a contrarian indicator, not an indicator usually that's associated with further strength in the future.
Really interesting points of view, Brent. Thank you so much for your perspective today.